Uncover the secrets banks don't want you to know in these 5 eye-opening revelations about money. From the surprising truth that any bank can create money to the hidden power of credit cards, this exploration could change how you view the financial system. As Henry Ford once hinted, understanding these truths might revolutionize our approach to banking. Explore the intricate world of banking and money through 5 revealing truths that institutions would rather keep hidden. From the surprising ability of any bank to create money to the secret power of credit cards, this video unveils the financial mysteries that could reshape our understanding of the entire banking system. As Henry Ford once hinted, the knowledge within could spark a revolution in our approach to finance. Before we start our videos, make sure to subscribe to our channel and hit the bell icon for our upcoming uploads. So without further ado, let's dive in. Banks, often considered the backbone of any economy, play a pivotal role in shaping the financial landscape. Even the Federal Reserve, perceived as a unique entity, functions as a bank, albeit with the extraordinary ability to create money. This distinctive power, however, isn't exclusive to central banks. In fact, every bank, theoretically, holds the right to create money to a certain extent, based on the deposits made by individuals. The mechanism behind this process is known as the fractional reserve system. When you deposit money in a bank, let's say $1,000, the bank is not obligated to keep the entire sum idle. Instead, they are required to keep only a fraction, typically 10%, and can lend out the rest. This implies that for every $1,000 deposit, the bank has the capacity to create an additional $900 out of thin air and lend it to someone else. While your account still reflects the full $1,000, the reality is that the bank has effectively generated money, contributing to the expansion of the overall money supply. The concept of creating money is just the tip of the iceberg in the intricate world of banking. One intriguing strategy individuals, even billionaires like Mark Zuckerberg, employ is borrowing money from banks at exceptionally low interest rates. In Zuckerberg's case, he financed a multi-million-dollar home with a mortgage featuring an interest rate slightly above 1.05%. The rationale behind this seemingly counterintuitive move is rooted in the concept of free money. Banks, notorious for offering meager interest rates on deposits, often make borrowing more appealing by setting rates lower than the inflation rate. In Zuckerberg's case, borrowing at a rate lower than the inflation rate essentially translates to acquiring money for free. This strategy becomes more potent when dealing with large sums, allowing individuals to leverage borrowed funds for potentially lucrative investments. The financial landscape also reveals a paradoxical relationship between wealth and interest rates. Banks, being profit-driven entities, prefer lending money to the wealthy over the less affluent. The rationale is grounded in risk mitigation, as wealthier individuals are considered less likely to default on loans. This historical trend mirrors the origins of banking, where institutions primarily served the nobility and those with stable income-generating assets. While this scenario may seem inherently biased, it underscores the fundamental principle that banks are businesses with a responsibility to maximize profits for their shareholders. This reality prompts a reflection on personal financial conditions, as those in a strong financial position are more likely to secure lower mortgage rates and credit card rates. Building a robust financial profile becomes a strategic move in negotiating favorable terms with banks. Blockchain and cryptocurrencies represent a technological leap poised to revolutionize banking, promising a democratization of financial services. This innovation, building on the centuries-long evolution of the banking system, marks a significant shift toward greater accessibility for the general population, challenging historical exclusivity. As these technologies continue to advance, the financial landscape is undergoing a transformation, potentially diminishing traditional barriers and providing unprecedented access to financial services for a broader demographic. This ongoing evolution invites individuals to stay abreast of emerging trends, recognizing the transformative potential that blockchain and cryptocurrencies bring to the historically entrenched world of banking. However, the traditional practice of keeping money in a bank for the purpose of earning interest is questioned as a potential ripoff. Major banks offer interest rates that barely exceed 0.5%, and even those with slightly higher rates often fall below 1%. Considering the current low-interest environment and the reality of inflation ranging between 4.5% and 6%, the real value of money kept in a bank is diminishing over time. The advice extends to exploring alternative investment options that have the potential to outpace inflation and maintain the purchasing power of wealth. This insight challenges the conventional notion of banks as institutions for growing wealth and encourages individuals to seek avenues that align better with their financial goals. In the realm of personal finance, credit cards emerge as powerful tools and, simultaneously, potential pitfalls. Statistics indicate that a significant percentage of Americans with credit card debt find themselves unable to pay it off promptly. The high interest rates associated with credit cards, often around 20%, create a precarious situation for individuals, with a substantial portion admitting to carrying credit card debt for extended periods. Credit cards, while beneficial for building credit scores when used responsibly, become potent weapons for banks when individuals fall into the debt trap. The ease of spending without immediate consideration for repayment contributes to a cycle where individuals struggle to pay off accumulating debts. This pattern, exploited by banks, underscores the need for financial responsibility when utilizing credit cards. In conclusion, the intricate dynamics of banking and finance reveal a complex interplay of power, profit motives, and individual financial choices. Understanding these truths can empower individuals to navigate the financial landscape more effectively, making informed decisions that align with their goals and aspirations. As the world of finance continues to evolve, staying informed and adapting to emerging trends becomes crucial for individuals seeking financial success. So don't forget to subscribe to our channel and hit the bell icon for our upcoming uploads. Until the next time, goodbye.